Ladies and gentlemen, good day and welcome to the Patanjali Foods Limited Q1 FY25 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not a guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjeev Asthana, CEO from Patanjali Foods Limited. Thank you, and over to you, sir.
Thank you very much. Good morning, welcome, and thank you for joining us today for Patanjali Foods Limited's call to discuss the results of Q1 FY25. I am joined by the company's CFO, Mr. Kumar Rajesh, along with Mr. Priyendu Jha and Mr. Chintan Kotak from the IR team. The team from our Investor Relations Advisor, the Strategic Growth Advisors, is also here. We have uploaded the results collateral on the stock exchange as well as the company's website for your reference. Please note that the call we will be referring to on standalone financials. I am pleased to share that we have begun this fiscal on a favorable note with strong growth and profitability metrics. During Q1 FY25, the revenue from operations stood at 7,173 crores. The total EBITDA stands at INR 435 crores in the quarter, which is 105.2% growth over INR 211.99 crores in Q1 of FY24. On a sequential basis as well, if we exclude the adjustments related to the pre-redemption of preference shares as per in day, the Q1 FY25 EBITDA had 4.8% growth from the quarter ending in March 24. Our PAT nearly triples to rupees 262.91 crores on year-on-year basis, while the PAT margins stood at 3.65%. In the edible oil segment, after subdued performance for multiple quarters, there were signs of recovery since the second half of FY24. The uptrend continued during this quarter too. The segment recorded healthy margins of 4.35%, which is better than the standard margin range in the segment of between 2 and 4%. The performance of the food and FMCG segment was also in line in the quarter 1 of FY24. The segment contributed 26.77% to the total revenue, which is at similar levels in contribution in Q1 of FY24. The performance details of the respective segments are covered later. The revenue from wind turbine power generation segment during Q1 FY25 stood at rupees 14.33 crores. The company fulfills nearly 20% of its energy requirements from renewable sources. A major highlight of the quarter was the initiation of the process of acquiring the home and personal care business of Patanjali Q1 Limited. The board approved the evaluation of the acquisition during the quarter, and later, on 1st of July 2024, it approved the acquisition of PAL's home and personal care business on a slump sale basis at a cost of 1,100 crores. We are waiting for the CCI approval on this as well as the shareholders' approval. I believe it is a milestone transaction which aligns with our company's desire to be a powerhouse in the FMCG space. This strategic expansion will help us improve the stability of our margin profile and open various avenues for future growth. Patanjali Foods has a proven track record of successful acquisition and subsequent business scaling. And we believe that the successful execution of this acquisition will create incremental value for our shareholders. Speaking about the macro environment, we see that the monsoon has hit the country evenly. We are optimistic for this to continue. With our already strong presence in hinterland, the company is positive about the rural demand moving northward in the coming quarter. There is a steady urban consumption also, propelled by higher disposable income and a growing preference for premium products. Additionally, increasing health consciousness and evolving consumer lifestyle have further fueled the demand for premium FMCG products. Moreover, the expansion of e-commerce and quick commerce has provided an additional impetus to the sector. Overall, as a company, we continue to execute on our strategic playbook by driving operational excellence, delivering innovative and premium products, and expanding our distribution footprint to build the foundation for high profitability and sustainable growth and create value for our shareholders. Distribution expansion and new product launches as per evolving consumer preference continue to be our pillars for growth. Innovation and premiumization is the driving force behind broadening our array of products to serve both the value and premium segments of the market. These strategic growth drivers collectively aim to strengthen our market position and sustain growth in the FMCG market. Coming on to the details of the segmental performance. In the edible oil segment, the company booked a revenue of 5,330 crores. EBITDA of the segment was rupees 231 crores as compared to the EBITDA loss of 99.61 crores in the Q1 of FY24. The revenue from edible oil was on the lower side due to downward pricing pressure during the quarter. Further, there was a slight dip in the demand for edible oil. This happened mainly due to the unfavorable weather conditions and the multiple regions witnessed adverse effects of the intense heat wave, which impacted the edible oil sales to a large extent. Despite all this, the segment performed robustly with high gains in profitability. This was mainly because of the stable price regime in the market and active strategies of price risk mitigation that we pursued. We continue to see an improvement in sales of branded edible oil, which constitute around 79.54% of the edible oil sales of Q1 FY25. Premium oil range under the Nutrela brand continues to grow year-on-year basis. The first quarter of FY25 saw both upward and downward price movement in the cash markets. Specifically, we observed a price correction of approximately 10% in April, followed by a steadier movement in May and June. Palm oil showed no divergence between futures and physical markets. Conversely, a 7% divergence was noted in soya oil, primarily attributed to a decline in the futures prices. During Q1 for soya oil, the basis movement was negative, which favored physical stock, leading to deliberate reduction in hedging activities. Conversely, the basis movement for palm oil remained nearly neutral, where we maintained an average hedge volume of 30%. We recognize that the oil market is sensitive to price movements. Thus, we have varied sound risk management strategies in place. Our hedging decisions are based on robust fundamentals and technical research. We optimally leverage opportunities by establishing new sub-accounts for strategic management positions. Furthermore, we achieved natural hedging by continuously adjusting our positions in response to market dynamics. Further, to overcome the inherent price sensitivity of edible oil, we are aggressively expanding our footprint in the oil palm plantation business. The oil palm plantation sector has an important opportunity for Patanjali Foods to attain lasting success. In the first quarter, we increased our cultivated land further to 75,661 hectares. Rapid agricultural expansion are being executed in collaboration with the farmers at large scale. We are conducting farmer training and exposure workshops in the new area. Coming to the food and FMCG segment, we achieved revenue of 1,953 crores in line with the performance of the same quarter in the previous year. The quarter-on-quarter revenue declined by 751 crores, primarily due to the drop in the food business for various reasons. There was a spike in the year-end of rupees 2,148 crores in the previous quarter, which was a year-end inventory build-up by the distributors. During the quarter, the segment recorded an EBITDA of 184.05 crores at a margin of 9.42%, compared to EBITDA of 360.77 crores in year-on-year basis in Q1 of FY24. The EBITDA margin is aligned, but there was decline in the food business. In biscuits, soya protein, and nutraceuticals, there was increased better performance and increase in EBITDA as well. And specifically coming to the food business, to give greater clarity on and convert that into two parts. The food business margin was 19.6%, driven by 52% of Indian foods, which are high margin businesses that we have. This was in Q1 of FY24. In Q1 FY25, the consumer staples rose to 70%, temporarily lowering the margins. Recovery is expected in the next quarter with increased sales of high margin products. Q1 of FY25, the revenue was 1,351 crores. The consumer staples categories was 946 crores, where the margin typically is between 3 and 4%. The Indian food sales dropped to 405 crores from 662 crores, affecting overall margins due to the high inventory and seasonal factors. This margin is expected to stabilize at 11% next quarter as high margin products recover in Q4. In the biscuit business, the quarterly revenue grew by 9.41% year-on-year to 381 crores versus of last year, versus 417 crores in Q1 of FY25. The premium range of our health biscuits in PATANJALI continues to exhibit encouraging results. The margin increased from 10.1% to 19.1% in Q1, mainly due to reduced inventory costs in the raw materials, both in terms of the wheat and palm oil, and sugar prices were softer. The freight cost efficiency that was achieved on account of the operational efficiency and the new solar installation that we have in the energy cost saving. In the soya chunk category, the Nutrela sales, we observed steady growth of 4.37% to 7,746 metric tons during the quarter. Nutrela maintained a healthy margin and continues to grow and drive its business. The nutraceuticals achieved a run rate of 14 crores during the quarter, which is on the higher margin trajectory. We are expecting to close the year with between 100 and 135 crores in FY25. We have complete restabilization of the business that is being worked out. In the nutraceuticals, it's a reworking of the strategies that are being worked out alongside the other strategies that the company is working on. The company remains resolute in its dedication to enhancing its brand building initiatives. Various endeavors have been carried out for Nutrela, Mahakosh, and Sunrich. The brand teams engaged in active campaigns during IPL while reaching a high viewership of several crores over the TVC. As part of strategy for risks related to supply chain, the company has also initiated a dedicated supply chain test for key commodities like wheat, spices, guar, etc. Acknowledging the best HR practices at the organization, we were also recognized as the best employer by the Golden Globe Tiger HR Awards at Malaysia during the quarter. With this, I conclude my opening remarks, and the floor is now open for Q&A. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bharat Shah from ASK Investment Managers Limited. Please go ahead.
Yeah. Good morning, Althanaji.
Good morning.
Question. One is on the food business that you referred to. So what I could understand, correct me if I'm wrong, biscuit business, both in turnover as well as margins, have improved. Also, that is the case with the Nutrela business. Both top line as well as margins have been in sync with our plan. What you refer to as the food business and what you subsequently explained, I could understand that you are looking at it in two parts. Indian or specialty foods, Indian ethnic kind of foods, and the consumer staples. So, what are these two activities that you are referring to? Can you Can you please explain each of those two parts? What are the underlying products that you are referring to? And B, what is affected, like in March quarter, where margins were kind of low compared to traditionally what margins we have enjoyed and what we think we need to have. Compared to that, March quarter also was weak. June quarter also has been weak. So if you can explain what has led to this. And finally, what is the outlook on both of these activities in the food business so that one can get a better picture ahead? You referred to something about 11% margin, but I couldn't fully comprehend.
So Bharat bhai, you'll allow me a couple of minutes to explain because this is a very important question. And so I will explain. There are two categorizations in the food business that we have. One is that we refer to as Indian food, which includes like cow ghee, which includes like chyawanprash, honey, medicated juices, and specialty products, which typically fall in that category. The second business is consumer staples, which are in general tend to be lower margin businesses, where it includes rice, atta, pulses, wheat products, dry fruits. It includes spices. It includes, there's a whole list based on suji, maida, sugar, salt. So there's a very large category that we have, which comprises of the consumer staples. So this is what it comprises. We have further segregated for the clarity of everyone here on the call as to how sequentially it has moved over on year-on-year basis and sequentially on the previous quarters, how this has moved and what exactly was the reason for this change in the margin dropping on this business for this particular quarter, and why it's an aberration which is going to get sorted out quickly. So overall, I'll explain that in Q1 of 24, our specialty foods were 706 crores and the consumer staples were 646 crores. The total revenue on that was 1352 crores. In sequence Q4 of 24, our Indian food was 662 crores and consumer staples had a big spike to 1,486 crores. In the Q1 of 25, which is the current quarter that we're discussing, the Indian specialty foods was 405 crores. There was a substantial drop of nearly 257 crores. And consumer staples was 945 crores, which was almost a drop of 541 crores. So there are two reasons for that this drop, and then I'll come to the margin construct as well. So one is that the year-end inventory built up typically by the distributor and retail segment that is there, which typically had driven the prices up substantially. So consumer staples, while it's an important category for us, both in terms of the revenue and the margin that it generates, it is not that it is being pushed aggressively, but there was a high demand period that we saw in the Q4 of 24, where we saw that there was a aggressive buying which was happening on various accounts. Basically, there's an expectation of the shortage. There was an expectation with the retailers and distributors of building up their inventories. There was an aggressive buying which we saw across the spectrum, which pushed up the sale to 1,486 crores. During this quarter, I'm explaining staples first, and I'll come to the Indian foods. The drop that we saw was after the inventory overhang. The heat was very high in this quarter under discussion in the Q1 of 25. There was high sales inventory that I've already explained. The inventory overhang was there. So basically the business came closer to normalized run rate of, I would imagine, in the consumer staples. And while I don't want to put my, put my numbers out to say this is precisely it will be, there can be variation of 10 to 15%. But typically I would imagine that going forward, this business would have a run rate of anywhere between 900 to 1100 crores. And, occasionally there may be windows in which this may drop, and occasionally there will be windows in which it will go up. This also, consumer staples, is another dimension on the margin side, that in certain quarters, because of the purchase cost of the inventory, there may be variations. It will not be massive variations like edible oil, but typically we will tend to have variations which can happen. So depending on the cost of inventory that you hold, depending how the market is willing to price it, there may be variations of anywhere between 200 to 300 basis points. Then we can clearly witness a change which can occur in the consumer savings business. So for example, in this quarter, the margin that we made on the consumer staples was 3%. We made about 28 crores on the consumer staples business. Now I'll come to and this was versus a very high margin because we had a low margin construct that we had in the Q1 of last year. The margin was closer to 10%, and that gave us a margin. And then the previous quarter, this margin was closer to 6% in the Q4 of 24. Now I'll come to the Indian food specialties, and so I'll come first to why this drop of 257 crores happened. We saw a large drop in the tea business of 161 crores. We saw the herbs business declining by 70 crores, and the others, there was a marginal decline of 26 crores. We have gone to the drawing board because it is the aberration is a little larger. One reason which is being explained and worked out is on account of the large buildup that they had in the year end, and the inventory which typically tends to get evacuated over next typically between 30 to 45 days. It took a lot longer on account of exceptional heat that the North India witnessed and several regions of the country. Herbs, on account of, again, pretty much the reason explanation is on the heat side, and likewise we had some other minor drops in Chyawanprash and honey, etc., which is not significant for minor order. So this was 257 crores. We believe that this course correction will happen pretty quickly in this quarter itself. We've already seen the green shoots of recovery in the month of July, and I'm expecting that we will see this coming back to normalized basis as we move forward in this quarter. Coming to the margin construct on the business, because of this drop, the margin in this quarter for the Indian specialty foods is 15.8% margin. We made 64 crores on a base sale of 405 crores. In the previous quarter, the same margin, which is Q4 of 24, was 138 crores, was at a margin of 20.8%. So the higher, the fixed costs, the advertising costs, the certain other elements because of the lower sales revenue on the Indian specialty food, because it went up, that is the reason. So broadly, going forward, the plan is as follows. We would segregate, for the piece, better communication, more transparent communication, that how the Indian specialty foods, how they are performing, and how the consumer staples are performing. Our focus is on both. It's not that we are doing one at the cost of the other. Thirdly, we want to make sure that the higher margin business of Indian foods does way better. But equally, we are focused on consumer staples because not only we find it of strategic importance to us, it also gives us a very healthy basket for distribution and retail side, which we are able to push and work through. So this was broadly the long answer to your short question. I hope it sort of I've been able to explain, what you asked.
No, thank you, Asthanaji. Just a follow-up on that. Essentially, what I understood was that other than biscuit and our proteins, the Nutella business and nutraceutical business, the rest of the food is either the ethnic specialty, which is a higher margin, and the staples, which are low margin, single-digit margin kind of business. So two things happened in the quarter under consideration June 24. One, that the mix was adverse. It was more loaded in favor of the staples. And secondly, because of the adverse and reduced turnover of the specialty ethnic foods, the overall margin further suffered because of the negative operating leverage. Second, correct me if I'm wrong, what you are saying is essentially both the mix and the margin therefore should come back pretty quickly. Is this aberration due to inventory buildup as well as the strong heat wave which affected categories like Chyawanprash and others? Is that what my understanding is correct?
Absolutely right.
Okay. And 900 to 1,100 crore turnover per quarter you mentioned. So what you're talking about is ethnic Indian specialty. Would have normalized 900 to 1,100 crore turnover? Because I couldn't fully comprehend that.
So I will explain that. So what I was saying is, I was talking more for the consumer staples. The normalized revenue base should be anywhere between 900 to 1,100 crores. It could be in some quarters, it could go higher, and some quarters it could go lower, because that is very supply-demand driven and stock, depending on how the stocks are moving. The normalized turnover of the Indian specialty food should be typically in the range of 600 crores to 700 crores. Is a broad ballpark range that we are expecting, which we want to grow sequentially.
I see. And margin, just to reiterate what we have discussed many times over the calls, normal biscuit margin should be 15% or 15 to 17% range. Our Nutrela business, I think, is 17 to 19% range. Ethnic Indian food that you referred to, would have what kind of margin profile? About 15, 16? What kind of margin profile one should?
I'll just slight correction. The biscuits margin have steadily increased. So I'll just this quarter was some benefit came on account of the raw material. Typically, we are saying that the biscuit margin will be in the range of about 12%, and they will steadily increase as the volumes grow. And second is Nutrela is 16 to 18% margin is that depends on soybean prices, but 16 to 18% margin is a rest assured number. We broadly have seen that without change, typically we tend to keep that margin. In the specialty food segment, our margin profile is 15 to 16% within the food category. And in the consumer staples category, the range while this quarter it has dropped, otherwise we are steadily maintaining between 4 and 6%. But typically it would be between 4 to 6% we should be able to manage in the consumer staples category.
Thank you, Asthana. One last thing. On nutraceutical, of course, compared to last year quarter, turnover looks very low. But it was discussed in the last call. I think we have revamped our nutraceutical strategy. So sequentially it has improved. But would you like to highlight what are the steps and what is the direction in which that business is headed?
Yes, absolutely. So in nutraceuticals, what we have done is that we are having a complete revamp in terms of the packaging, the go-to-market strategy of both through the new channels like D2C and e-commerce. The target this year is that while last year was we went through ups and downs significantly, but new product launches we have done. We've done 6 product launches recently. In the last quarter, we launched gummies. We launched new sort of variants of our vitamin powders that we had. We launched those. We came out in terms of working on the channel I spoke about and looking at ensuring that we achieve our target ballpark range. What we said was 125 crores of revenue this year. At 25% margin is what we should achieve. There is a reasonable confidence because of the cost base, and as we increase the revenue, this margin will keep on improving. Potentially, certain margin products are way higher, but on a blended basis between low margin, high margin products in nutraceuticals, we are targeting 25% of margin. And this year, we will, at the end of the year, I'm reasonably confident that we should have anywhere between 100 to 125 crores of revenues coming out of nutraceuticals. It's early days, but it is showing a definite trend towards upward trend, and we are progressing in that direction satisfactorily.
And what kind of longer-term growth rate we should assume on this business from 125 crores in the current year onwards?
So we should expect 25% of growth, because once the momentum gets established because of all the changes that have happened in last 4 quarters, and we should expect between 20 and 25% growth rate that we are targeting in nutraceutical change. Because one of the key drivers of that will be, both not only the domestic market, but the exports market as well.
Thank you so much.
Thank you, Bharat. Thank you so much.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Dheeraj Mistry from Antique Stock Broking. Please go ahead.
Yeah, hi. Good morning, sir. Sir, first question is on cost line items. So in this quarter, there's a lot of volatility where other expenditure, depreciation, interest have reduced by 15 to 20%, and employee cost has increased by almost 50%. Can you give rationale for that, and what can we expect on a steady state business?
Rajeshji, I would leave it to our CFO to answer that question.
Yeah. So, Dheeraj, I would like to explain. The employee cost has been increased due to the allocation of cost on account of ESOP, which was earlier also in the previous quarter, it was allocated for 1 month only, and this quarter it was allocated for full 3 months, and it amounts to near about rupees 30 crores. That's why it has been increased, employee cost.
And depreciation and other expenditure, reason for the drop?
In case of depreciation, basically in the last quarter, we have done the year-end exercise, and in the year-end exercise, we have just impaired certain closed plants to the tune of near about 30 crores. That's why this has been reduced. This quarter, this is the first quarter, hence it is not required in this quarter. Further, the other expenditure basically reduced in the ordinary course of business because of reduction of sales.
Okay. So can we expect for depreciation and employee costs, this quarter run rate should be maintained for another 3 to 4 quarters?
Yes. Depreciation is near about 58 to 60 crores. This is a normal, subject to some additional depreciation due to addition in the fixed assets or some retirement of assets, that is very minimal amount of retirement. So run rate is near about 58 to 60 crores, and employee cost is obviously will be maintained.
Got it. And Asthana, can you run me through, sorry if I messed out this, so what would be the EBITDA for food business, biscuit, neutral and nutraceutical for this quarter?
So nutraceuticals is marginally negative, and because it's still not covering the cost. The biscuits business is 81 crores of EBITDA, and Nutrela is 16 crores. Food, as we talked, the consumer staples and Indian ethnic foods together is 92 crores, and the total is 184 crores.
Got it. Okay. Okay, that's it from my side. Thank you.
Thank you, Dheeraj.
Thank you. The next question is from the line of Piyush Bangar from Regis Global Securities Private Limited. Please go ahead.
Very good morning, Mr. Asthana. I have a couple of questions around palm plantation. Am I audible?
Yes, you are audible. Yeah, please go ahead.
Okay, so my first question is, how much land procurement rights we have right now, and out of which, how much land we have already acquired?
So in terms of the allocation of land, which is subject to the government saying that this district or otherwise you have to do, we've got very large 600,000 hectares of land that is available to us. across northeastern 5 states, Arunachal, Tripura, Mizoram, Assam, and Nagaland. And similarly, if I include Telangana, Andhra Pradesh, Karnataka, and Tamil Nadu, and other some few minor states, the total land available is 600,000 hectares, of which we have crossed 75,000 hectares that we have planted already. So the issue is not in terms of how much land really is made available, because that is available. The way farm plantation business works is that, how you're reaching out to the farmers, how many farmers are getting converted, how much of nurseries have been put up to be available to give the saplings to the farmer, and over a period of time to be consistently working to ensure that the farmers continue to plant and bring their land under the oil palm cultivation. Now this particular thing, this year is a year of substantial change. We are anticipating that while the target is 25,000 hectares, we will see that how it plays out, because it's subject to the farmers coming on stream and doing it. So from 75, we will certainly move closer to 100,000 in next 3 to 4 quarters, and thereafter it will continue to expand at a very rapid fire pace. And that is what the status in the land part is. We have 42 nurseries. We have all the available saplings, the seedlings which are available in terms of giving to the farmers. And, there's a, farm mill construction is going on at Arunachal Pradesh. That's completed almost. The Mizoram mill is coming on stream. We are expanding our capacities at Siddhapuram and Ambapuram. We are scouting for land sites in Telangana. We might be expanding our Ambapuram facility to go to Vizag. So there's a lot of work which is going on, and it is going to reflect both in terms of the numbers that we have in the planted area, as well as in terms of the broader increase that we have sequentially each year in terms of new areas which were already 0 to 3 years of age, which will keep under fruiting.
Okay, thank you very much for that. As you said that we have already planted 75,000 hectares and we will plant about 25,000 in upcoming 2-3 quarters. Can you please guide how much we are expected to plant in the upcoming 3 to 4 years? In numbers, I could just say.
Yeah, so target is very clear that we will have at the end of 4 years, or it could get extended. We'll have 500,000 hectares of land which will be under cultivation. Now, in these matters, giving very precise numbers typically is a challenge, because the farmers tend to have their own sequencing of how they bring it on stream, the way we work. But in 4 years' time, I think it's safe to assume that we will have close to 500,000 hectares of land which will be planted.
Okay. My another question is, we have major land rights from Northeast region. So do you have any kind of safety issues or something like that?
Sorry, your voice broke. I didn't get your question. On the Northeast, what are you saying?
Okay. I'm saying that in Northeast we are facing some kind of instability. So do we have any kind of safety issues there?
No, there's no problem. I think that it's isolated to only one case where we don't have any opposition. So in general, from the instability front, we have no such problem, and it's going apace. It can take time, because farmers and producers are looking at in a particular way of how they gravitate. The governments have to be very supportive. So that is there, which is the main reason that the many times this control does not lie with us in terms of how fast it will get planted. But I'm reasonably confident that the number that I spoke about in 4 years' time, we should be very close to that number.
Great. That's a good set of numbers. So another small thing which I want to add to this is how much yield per hectare we are expecting from the plantation.
So typically, right now, what we are getting is about 2 tons of CPO, to farmers that we get. And this should go up only, because the germplasm that we get, the quality of leaves that we are getting is becoming increasing. So for example, last year we had 102,000 tons of oil, crude palm oil that we were able to extract. And if you multiply that with about 5.3 times, 5.4 times, you will get the FFB, which is typically about 500,000 tons of fresh fruit bunches that we got last year. So this should sequentially improve only because I think the quality overall is improving. The varieties of the trees that are getting planted are becoming more lesser in height. So they're more dwarf varieties. And so I'm expecting that we should certainly targeting that we should get closer to 2.5 tons. Otherwise, in Malaysia and Indonesia, if you go, the fields are giving up to 3.5 tons as well. So some ideal growing conditions like Andhra, etc., we should get closer to 3.5. But on an average, our target is we should get closer to 2.5 tons of two farmers, per hectare.
Great. My last question about the farm plantation that do we need to open any new testing sites with plant and machinery for this upcoming project? And if yes, then how much capital expenses are expected with the timeline?
So, for example, we have got one site which is under construction right now in Arunachal Pradesh at Pasighat, Nichok. So that investment is very low because it is 5 tons for our, crush capacity. So that investment is about 25 crores. We are going to put up a new mill in Mizoram by next year. That capex will come up. But in terms of the large scale capex is more back-ended for us, which is going to be in Assam, in Andhra Pradesh and Telangana, which I'm anticipating that after 3 years, when the crop size becomes larger, then we'll have almost I'm expecting 800 to 1,000 crores of capex we'll have. So it's very back-ended in year 3 and year 4 is when that capacity will come up. Otherwise, these are smaller expenditures that we have, both in nursery and the smaller mills that we are putting up, both as part of an obligation that we have to the state government and the farmer, as well as, so that the fresh fruit bunches which are coming should not go waste. So that we are ensuring that we're putting up smaller capacities and not larger Mizoram in that sequence. And if required, we'll be putting up in Assam as well, but that probably is going to be closer to later next year, not at this time.
Great. Thank you, sir. For the next question, I'll come up with you.
Yeah, thank you.
Thank you. The next question is from the line of Payal Shah from Billion Securities. Please go ahead.
Good morning, sir. Thank you so much for the opportunity. I have one question. Can you give some color into Q1 performance for the home and personal care business which we are acquiring?
So I would not be able to give you that right now because that probably is going to come later. I can give you some sense about about the overall business. Is that what exactly does it comprise of? So right now what we have is that I'm giving you the annual numbers. I may not be able to give you a flavor of exact Q1 numbers simply because right now it's not available with us. We do about 1345 crores of revenue annual last year's number on dental care side. 1345 crores. We did skin care business of 725 crores. We did home care business of 410 crores. And we did hair care business of 291 crores. So this was the revenue overall that we did on an annualized basis. So yeah, I don't know if that I've been able to answer your question. I think this was the annualized.
So any details on the Dant Kranti performance, if you have, that would be quite helpful.
Sorry, which one performance?
Dant Kranti.
Yeah, so Dant Kranti is, as I mentioned, it's 1345 crores is the revenue. In terms of the margin, sort of profile is quite high. It's close to 40% plus. And plus, we've recently launched, sort of new variants in Active, Fresh, etc. with new brand ambassadors in Tiger Shop and Savannah Bhatia. So the ads are on the air, the distribution products are there, and there's a reasonably good response that we're getting in the marketplace. So yes, I think I will be able to give you only this much, and not because we don't want to. It's just that simply that's not available to the level of detail you might be seeking.
Sure. That's quite helpful. Thank you so much.
Thank you.
Thank you. A reminder to all the participants that you may press star and one to ask a question. The next question is from the line of Shirish Parvesi from Centrum Broking. Please go ahead.
Good morning, Asthana ji and Rajesh ji. Thanks for the opportunity. Just to continue on the newly acquired business, what I wanted to understand, do you think another 1 to 2 quarters the business will get fully integrated, and what are the steps which we are taking? And meaningfully, if we are banking on the distribution expansion for the newly acquired business, do you think within 3 to 4 quarters we will be up and running fully?
Are you talking about the HPC business or?
Yes.
Okay. Yeah. So I think one is that, the timelines, obviously the regulatory approvals we will have to wait. We are hoping that in the normal course in 4 weeks' time, we should be getting that, maybe 4 weeks, maybe 6 weeks at max. It will take some time for the full value to sort of, accrue. We were estimating that it should add, at least 100 to 200 basis points to the margin construct with the better distribution efficiency and otherwise. It should take certainly between 3 to 4 quarters for the full integration to happen and for us to move forward. But fact remains that whether it's going to be the distribution side, whether it is in terms of some bit of rationalization or substantial rationalization that we're aiming for at the ground level of the organizational structure that we have in the cost base that we will have. A certain degree of the marketing activities that we could consolidate and convert that into more structured sort of way between food and non-food side. So yes, I'm reasonably confident that the integration will happen. It will take its time, but certainly that the real benefit from the next financial year for sure, and hopefully the last quarter of this year we should start seeing the benefits of some early sort of benefits starting to accrue to the company.
Okay. Now, why I'm asking this question, historically, I think if you can help me to understand, our food and FMCG business contribution in the south was lowest. Will this complement in a medium to long term, or how one should look at it?
So it will. I mean, really that, there is a distinct sort of, that we need to improve certain regions where a lot of company effort is going on to develop and build that up. So for example, the strength, if I were to sequentially move in different products. So how we need to certainly work on and get better. And we can be confident that, the HPC business having wider appeal, I think we should see the benefits of that accruing in South. But having said that, it's not that South is, for example, our Ruchi Gold palm oil is the highest selling brand in the country. Most of it sells in South. A lot of our businesses like, for example, the biscuit business is expanding very rapidly in southern part of the country. So it's not that it's a one size fits all, but yes, the Indian ethnic foods category, if I were to look at, a lot of them are very, both in terms of the traditional usage or otherwise, they're more centered in north and western part of the country and central India and less in south. So I think that variation we witness often. But synergies overall, it's not just south, but I think overall within the country itself at a national level, it should give us the benefit.
Sure. My second question on the biscuit and segment. You mentioned that 417 crore, what we have reported, has grown about 9.4%. Just need to have a little more qualitative aspect. What is the volume growth, and is there any price decrease we have taken in this quarter?
Yeah, I had the volume growth here with me in terms of, so we haven't taken any price decrease at all. So I think the broader adjustment has been a lot more in terms of the grammage, and that adjustment happened because really the price pressures have been there, and adjusting to the market was a larger sort of point that we had. So based on that we worked, but overall it has tended to grow, and I'm trying to pull out on the biscuit side. Our volumes have grown both. Our volumes are also growing consistently, and we're seeing the revenue growth as well. But the settlement adjustment has been a lot more on the garment side and pack size changes, et cetera, which have tended to help the business growth.
So will it be at least 200 to 300 basis points higher than the revenue growth in value terms?
Sorry, what is the question? Can you just speak a little louder?
No, I'm asking the volume growth, what you've reported, 9.4% value growth. So volume would be at least 200 to 300 basis points higher than what you were reporting?
Definitely. No, the volumes are consistently growing.
Okay.
And typically the volumes is quarter-on-quarter is growing, and which is there. And so to that extent, it's, we would say that, for example, like, what was a very high pace of growth that we saw, and this quarter was, of course, one of the slower quarters, typically. I think this now is going to pick up pace. So typically, I would say that, 2% to 3% will be the volume, and the rest of it will be coming on the value side.
Sure. My last question, you mentioned that there was a price decline in the edible oil. In the medium term, I would expect the prices are firming up. So if you can help us to understand what are you building in second half? Is there price increases or this price deceleration will still continue?
So it's actually the jury is out. That's something that we're grappling with right now, because and there's a much more macro pointer that the world itself is not having too much of surplus oil. These mandates on account of biodiesel, etc., which is both in the US and Brazil and what we're seeing in Indonesia, they're moving towards B40 next year. So the availability of the edible oil in general for the global markets is becoming lesser and lesser progressively. Whether that reflects back in the price increase, we don't know. It looks reasonably stable for the moment, and I'm hoping that it stays that way, because if the prices were to go up, it tends to immediately have an impact on the margin profile, in our range of businesses that we have. Not only just that, but even on the business also. So typically, that's what we are tending to sort of deal with. And likewise, I'm saying that, for example, on the other commodity side, maybe unrelated, but very important, that, I'm expecting that the wheat, for example, government has come with stock control order, but there is a clear-cut sign that there will be high spike in demand, and the wheat prices will go up. So all these elements tend to add, to the pressure on the pricing for various other products also, categories. So we'll have to see. But broadly, I think this quarter it should remain stable. Thereafter, we'll have to see that how when India starts to harvest, the soybeans and other range of oilseeds, winter oilseeds come. So we should be okay for the moment.
Okay. Thank you, and all the best, sir.
Thank you.
Thank you. The next question is from the line of Niranjan Jain from Trust Security. Please go ahead.
Hello, good morning. Am I audible?
Yes, if you can speak a little bit.
Yeah. So while going through your results, here you saw that there is some slight dip in the revenue.
There's a lot
Sir,
of
you are
background noise
not
from
clear
your
at all, I think. Yeah.
Yes, sir. May I request you to rejoin the queue?
Okay.
Thank you. The next follow-up question is from the line of Piyush Bangar from Vijit Global Securities Private Limited. Please go ahead.
Okay. So again, I have something around palm plantation only. So my question is exactly how we are managing to supply fruits to crushing factories and, the transportation all around factories. Like what kind of transportation mode we are going to use?
No, so the farmers bring the FFB to the plant, to the oil unit, and the responsibility lies largely with the farmers to bring it. We help them, but they bring it to the factory gate.
Okay, so exactly what will be the major mode of transportation? Is it by road or railway?
Yeah, by truck. No, by truck only. Because these are smaller farmers, typically which will have 2 and 3 hectares of the plantation. So they will hire a truck if it's very in the close vicinity, tractor trolley, and they will bring it, but never moves by rail at all.
Okay, great. My second question is, at the palm oil mill, we get mulch as a byproduct, which is, also can be used in production of biofuels. So do you have any plans in future to, produce biofuels or something in this category?
No, so we are doing that already. So the husk, that sector that is used, it is being used in the boiler. So it's got very high calorific value, and that is being used not only at the boilers at our own plant, but also in the refineries which are close by, our own refinery. So we're moving it toward that. So any byproduct that is there, the biomass that's available, that is getting used. And where if we don't have the use, there's a ready market available for that, which will get utilized. So there's zero wastage on that front.
Great. Thanks for the opportunity.
Thank you.
Thank you. The next question is from the line of Niranjan Jain from Trust Security. Please go ahead.
Hello, now I'm audible?
Yes, I think if you don't speak, if you take off the speakerphone, it will be much better. It's slightly our third line.
So my question is a little bit simple. What is the reason for increasing the oil margin? Because compared to last quarter, negative is almost 100 crore. Now it is almost 232 crore. Is there a branded possibility or maybe there is some other reason? And second question is, what is the volume growth in this business comparable to year-on-year growth, year-on-year period?
No, I'll explain that to you. That just I'll give you the breakup also. So in this quarter, 232 crores is comprising of two parts. One is that the refining and branding that we have, that is 185 crores, and 47 crores is on account of the oil palm plantation business. In the last year, when we had, it was negative 144 crores for the refining and branded segment, and 46 crores plus in the palm plantation side business. So that side was 98 crores negative. So the reasons are both, as we had the witness in the Q1 of last year, Q1 24, was that, the prices were extremely volatile. We had higher priced inventory. The hedges did not work well, and the Indian market was not willing to pay. So that's why there was a negative of 144 crores that we witnessed. As I mentioned during the call also, the prices are much more stable. So when the stability in prices is there, there's a marginal part of it if you're carrying the inventory on a structured basis, because the premium that we have on a branded segment that we have, that allows us to make a more regular margin. So as a company, it typically tends to carry, has to buy the product ahead of time, ahead of the sale. We always would like stable market regime to be earning consistent and regular margin.
And what about the volume growth? Do you show any volume growth on the oil segment?
Yes, I'll explain to you. So, for example, in the Q1, our volume in the edible oil segment actually compared to the Q4 of 24 has dropped by 50,000 tons, because this is typically about 10% drop, because this typically is a low demand season. Summer months, a lot of demand, for example, goes down, and the marriages are not there, the functions and festivals are not there, so it has grown. So our exact volume I'll share with you. The Q4 of 24, we were 638,000 tons of sales that we did. This quarter, we did sales of 574,000 tons.
And what about the Q1 FY24?
Q1 FY24, the volumes were 622,000 tons.
Okay. Thank you.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah. So, thank you very much for this session. With this, we'll conclude the call. And if you have any further queries, you can contact SGA, our investor relations advisor. Thank you very much, and everyone, have a good day.
On behalf of Patanjali Foods Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you. Thank you to all.
Thank you.